All right, so today I'm going to dive in a little deeper on custody for your Bitcoin, also kind of the strategies that are being implemented across the industry with all the things happening within the banking sector, with what we're seeing around regulatory scenarios. A lot of people are asking that question is how custody is going to be managed. There's a handful of solutions out there and a lot of different angles in which you can do it. And many people that we talk to I've been asking, let's do a little bit more of a deep dive on this. So we definitely are going to bring in BitGo today and talk a little bit deeper about that. But anyway, my name is Paul Barron. Welcome back into TechPath. All right, so before I get started, I do want to thank our sponsor real quick. And if you guys are not heading over to Consensus 2023, make sure and stop in. This is I would think one of the largest events that covers the crypto space in its entirety because it's doing everything from Bitcoin all the way up to Web3. Of course, hosted by CoinDesk. And we've got a special discount for you. So make sure and use the link down below. You'll get a 25% discount on your tickets for the event. I will be there. And make sure, just let me know out on Twitter. Hit me up at Paul Barron, DM me, and let me know you're going to be in town in Austin during that event in April, which is the 26th through 28th. Again, just click the link down below. All right, I'm going to open with a clip today and give you guys kind of a little bit of understanding what the industry is dealing with of how all of this regulatory environment might play into us. And then we'll actually bring on the guest who was in this clip. Let's play this real quickly.
Chair Gensler has insisted that the SEC's 2019 framework provides sufficient clarity now for market participants to apply to the securities laws to the digital asset ecosystem. And he's repeated on his routine CNBC appearances and other television appearances that one just has to come in and register is sort of a theme for him, and that he'll work with them, and that's how it's going to be since 2019, and it's been effective.
You know, we did visit the SEC all the way back in 2018. It's worth noting that this is not the current administration's SEC. This is the prior administration's SEC. So the problem is not any specific administration. It's actually systemic to just getting questions answered. The basic question of how should those covered by the Investment Advisors Act have custody obviously should be answered. Second point to note is the common problem around ruling by enforcement as opposed to ruling by direct answering of what is allowed and what's not.
All right, so Mike, welcome into the show. We appreciate you stopping in today.
It's good to be here, Paul. Thanks for having me.
Yeah, so I played the clip there mainly to set this up in the sense of understanding the challenges within the industry. And I say crypto industry, more importantly, this is really a financial services side of things that is being pretty much reconstructed as we go right now with what's happening with the current banking scenario, Silicon Valley. Obviously, we saw the thing with Credit Suisse. We're also starting to see other regional banks running into these challenges. Custody is going to be one of the biggest issues. You mentioned that in your testimony to Congress. When you look at it from a strategy standpoint, first of all, for what BitGo is doing, give me a quick rundown quickly of what BitGo does around custody, and then I want to get your opinion on where this might be going in the next few years.
Sure. So BitGo is a qualified custodian. What that means is we're registered in numerous jurisdictions and regulated as a custodian for safekeeping of assets. The primary job of a custodian is really simple and really boring. It's making sure that the assets are safe. It's a little bit of reporting around it. And we have regulators under New York DFS, regulators under the South Dakota Division of Banking. We have international regulators in Switzerland and in Germany, all kind of looking at how we operate our business. So everything is segregated storage on behalf of our clients. It's protected bankruptcy remote, meaning that if we go bankrupt, our clients all have their money, goes back to them. And custody is not a surprising thing. Gary Gensler and politicians and regulators all over the planet have been taking a deep, hard look at what is the role of custody in terms of building market structure for digital asset markets. And right now, the way markets have formed in the digital asset space is that you don't have much of a market structure. So it's not as robust as what we have in the equities world or in the derivatives world. And what's being figured out now is how to address that problem.
I look at custody and then I also look at adoption, the scenarios, and I talk about this all the time on the show, is I work with a lot of high net worth individuals, and that's usually one of the biggest issues is one, dealing with an exchange. how to hold Bitcoin and other assets, digital assets in general. Obviously, that whole process, then you get into self-custody, you get going down a rabbit hole that is another, learning curve in many cases for people like this. I was looking at your website. Now, you guys do things a little bit differently from a custody standpoint: hot wallets, custodial wallets, self-managed cold wallets, NFTs, collateral management, trading, etc. And you even go into staking and DeFi around the BitGo network. When you look, okay, so this is typically a little bit different than what you see normally from custody organizations that are out there. There's a handful, I won't mention names, that do just Bitcoin only, scenarios playing in that. You guys offer a lot of products. I'm kind of curious, are you seeing more individuals wanting to do custody type products and services around some of the things like NFTs and so on right now? Or do you feel like it's more in the premium assets?
No, look, I mean, absolutely. Those are growing. Look, today, sure, Bitcoin, Ethereum, kind of the premium assets are the bulk of what we deal with today. But what we have in the industry is the intersection of money and technology. So all of a sudden, anything that was technology can now be digital property. And once it's digital property, it has a value. And once it has a value, it starts to look like money. And that means you need to be on markets. And those markets are going to have different types of safety behind them. So the NFT front, which I think we've kind of just scratched the surface of digital property there. We start to have companies, corporates that are building customer loyalty programs and engagements, and they are now creating assets which have value. And then they're worried about what is their obligation to make sure that they treat that properly. What are their liabilities? Should they not? We're coming to BitGo for answers. And it's the same thing as if you're a financial institution looking at how would you treat cryptocurrencies as an asset on your books. So back to the question about kind of all the product lines that BitGo offers. First and foremost, at the bottom layer of what we do, we offer a set of wallet as a service technologies. We've been doing this for 10 years now. We're the first ones to do it, certainly at an institutional level, but really kind of anywhere. And it's how BitGo has grown so large. BitGo is behind the scenes. It's embedded as a white label product in exchanges, broker dealers, hedge funds, and others all across the planet. And they're using BitGo wallets to secure their funds at a purely self-custody level. That is, we provide the technology, we provide some multi-sig that eliminates the single point of failure that they need, and that's used all over. Yep. The thing we're most known for more recently is the custodial aspect. And this is where you start to blend it into the true financial institution. And anytime you have a fiduciary, and what we were talking about with the House the other day is, what is the rules of custody under those that are governed by the Investment Advisors Act. So if you've got a large fund or a large VC fund, what cautions, what care do you have to take of the assets that you hold on behalf of your clients as per the SEC? And is that a BitGo type of custody? Is it some other type of custody? And today what we do have is a number of people doing self-custody when they're holding other people's money. And this is a danger. We do know that could have issues, and we're trying to sort out exactly what the rules should be for the industry.
Yeah, it is. It's a challenge, I think, because it's so early. Most people who are doing these kinds of transactions, whether it's self-custody, going into a cold wallet like a Ledger or a Trezor or something of that nature, in many cases, this is a very new experience for them. And in most cases, when you look into high net worth individuals, institutions, et cetera, starting to go in that direction, that's a whole different, ball of wax in terms of what you really need to be doing around self-custody. I want to jump over to news on Fidelity. So Fidelity, of course, announced, kind of a soft announce that they're going to be allowing crypto into their campaigns. And I was looking at this report that they filed, and this is their methodology of where this might play out in terms of investors that could be coming in. Let me zoom up on that just a little bit. So this was kind of the layup from financial advisor, high net worth, family office, pension, et cetera. So mostly, we won't call them high traditional investment classes, but these are within institutional grade investment class. And you look at the areas, this is the period in which they were doing the research. Then they find out that the attitudes toward Bitcoin and digital assets were starting to increase, even in a bear market. And then I was surprised to see the perception of digital assets. This is 21 to 22. And you'll see from 49 to 51 on perception of Bitcoin. So again, all these are really good signs for institutional capital now with a potential tool set like traditional, brokerage and or banks that could be going in this, Fidelity being one of the first ones. And there's been others that have been done this, but mostly with high level institutional grade. How does this affect the market at a whole? Do you find more banks that might go into custody services where BitGo might become a partner with that? What is your thought process here around adoption?
Look, I was just on the phone this morning with a, I don't know, top 5 bank in the world, talking about this exact topic. Every single bank on the planet, I guarantee you right now, already has a team that's working on how to take on digital assets. And they're trying to figure out, are they doing it themselves? Are they looking for technology partners? Are they looking for sub-custodians? You'll hear different answers from different institutions. They're looking and exploring how to do it. So the interest is going nothing but up. And I don't think we should be surprised by this. Digital assets are radically different from what we've seen with other types of assets. They're different in terms of them running 24/7. They're different in terms of them being bearer instruments. They're different in terms of them being technology and cryptography based. They are different in terms of being global. So these create a number of challenges for traditional firms, and we should not be surprised that either the institutions or the regulators take some time to figure this out. It doesn't fit within the parameters of what they've seen before. But the education is happening. You've got this show right here contributing positively as well. But all of this education, as people see Bitcoin survive, 15 years now, right?
Yep.
Like when Bitcoin was a 3-year-old asset, how much confidence could a traditional firm have in it, right? It's 3 years old. Now, 15 years, that's a big difference. So, as people get more educated, as longevity proves to be true, every single bank on the planet, of course, they're investing. They recognize that digital assets and blockchains are a game changer for what they do, and they're engaging with BitGo to actually figure out how to do that.
I have a kind of an interesting angle on this because obviously when you look at banks, you're looking at the fractional reserve system, at least here in the United States. These are not one-to-one assets. In many cases, they're loaning out this, many times over upon a deposit. How do you think this plays out for the crypto? Because we've already seen some bad scenarios play out with Celsius, Voyager, FTX. Granted, these are not traditional banking instruments. How do you think that's going to play out within digital assets, especially around custody? Because in this scenario, it's so easy for someone to move 100 Bitcoin out of an account so quickly. So a bank has to literally be able to manage that custody in a way that it is true one-to-one on assets. What are your thoughts on how that might play out? Because that's a different strategy for most banks. It's no longer fractional reserve.
Yeah, look, the digital assets make it better for the investors in the end. They make the financial system more stable. I know it doesn't seem that way based on the recent history, but when you break down these problems, like you mentioned Celsius and Voyager and BlockFi, these are not crypto companies. These are centralized firms that were helping you invest your money, and they take your money and they do investments, and those are of different quality, and they're all pretty new companies. And we saw some big failures there. FTX was an outright fraud. It was the exact same thing as what happened with Bernie Madoff. There will be fraudsters in every industry, and regulators and industry need to build structures that root them out as quickly as possible. I think the lack of market structure in crypto made it so it took longer to root out SBF than it otherwise would have. But those aren't really crypto problems. Now let's talk about the crypto advantages. The crypto advantages are that the assets are on chain and everyone can see them, which means the entire world becomes somewhat of an auditor and it has the ability to verify funds. So this move away from fractional reserve banking to 100% reserve banking becomes possible. Things like staking make it so that you can do this without having to just pay fees on it, which gets it more comfortable for businesses and individuals alike. And then the transparency is going to reduce the risk so that in the end, when you look at what's the factor into the price of trading or moving money? Well, I mean, it's 3 things. It's the cost of moving it, the profit that you want to take, and covering the risk that's being done. When you have all of the assets on chain, you actually reduce the risk. So long-term, digital asset markets come through as both more transparent, lower risk, that means lower price, more efficient.
Yeah, for sure. I was looking here at the further in the report. It says the role of digital assets in portfolios. This was basically also going into that same research to find out if investment and fund managers would be interested. This was 81%. I'm going to kind of zoom up on that a little bit. 81% right there, institutional investors surveyed that digital assets would have a role in investment portfolios. What was interesting here, investors in Europe and Asia report more acceptance of digital assets than portfolios in the US. This is something I just got off another show with another analyst, and we got into this very issue, is adoption rate around the world versus adoption rates in the US. You look at Fidelity, a lot of regulatory uncertainty, as you testified there at the House. We've got what I would think is, I still can't figure out if Gensler just doesn't know, doesn't care. I'm not sure what's going on with that, but it appears that we could see at a lot slower pace. With the fact that you've got Fidelity jumping in, that means other banks, to your point, they're coming quickly. Does the SEC change their stance as traditional finance starts to move into this space, at least here in the US? Because I know what's happening worldwide.
Look, I think there is a political element on top of the business element that's happening right now. And, you know, I haven't paid a lot of attention to politics in general. I don't really care about most of the political issues, but having been exposed to the House last week, it's interesting to see the process. You know, the Republicans are now in charge of the House, and you know they call their witnesses, and there's a way that the Democrats call theirs, and it's so politicized. It's unfortunate. I do think that the chair of the SEC, being a presidential appointee, it changes with each administration. Now, I'd point out, you know, and you heard this in my testimony earlier, that right, this isn't just Gary Gensler. Like, we went to the SEC back in 2018. It took 4 years to get a basic question answered. So that's too slow under all administrations. And I do think that they're trying to do better. But it's unfortunate the political thing is there. Now, separate the political thing. Look, the fact is that digital assets, people want them. They give you transparency. They give you control. They give you the ability to take ownership of your own destiny. So it's going to win out long term. And I think the reason you've seen those regional differences, like between Europeans and Americans in terms of level of interest in digital assets, is in part because Europeans feel it much more acutely just how likely it is that a bank can fail. They have had bank failures in more recent history than Americans have prior to this last week. Now, this last week, Americans suddenly got a dose of that. And as Americans start to realize, you know what, those banks, that fractional reserve thing isn't quite as simple and safe as you thought it was. That's going to make people start looking for, like, okay, how do I need to be preserving my wealth? And this gets into another fascinating topic, if you want to go there, around what's happening around the world with why are people reaching out and trying to use Tether, you know, in Turkey and Venezuela. And it's a fascinating topic. It ultimately comes down to human rights and people. That is, we all have a fundamental right to go to work hard, earn money, store that money, have that value be preserved, and then eventually spend that money on our livelihood, our children, our educations. Unfortunately, when the currency gets devalued behind your back, that leaves you in a really precarious spot. Americans haven't felt it as hard as other parts of the world have, but they felt it in Europe. They felt it when in Greece and Italy, there's been pure just bank seizures of assets, 1% of your wealth gone today. And they felt it in Venezuela, and they felt it in Turkey, where they've had massive devaluations of the currency.
How do you see that playing out with, obviously with over this past weekend, the depegging of USDC? Obviously it repegged immediately after, once they got security of their funds coming out of Silicon Valley Bank. But that's just a very small microcosm of what could be happening, especially on a stablecoin like USDC. Then you step away and you look at Tether being an international stablecoin, much more global appeal in use case, obviously a lot more volume. What do you think the stablecoin landscape looks like in the next few years? Do you think we continue with these two titans, or is this going to continue to shift possibly into some sort of CBDC?
I think we're probably going to stay with the private stablecoins for a while. There's a lot of talk about CBDCs. I think some of the more centralized governments will be more effective, like China, at rolling out CBDC. It takes a lot of decisiveness to really do that rollout. I know there's talk about it in probably 20 plus countries, but I think those are mostly pretty far away. And I think that a partnership between private and public sectors is the best way to deploy a CBDC. Most people here in America forget that actually the Federal Reserve System is actually a set of private banks, technically. And there's ways for private industry and public sector to interface that can be pretty positive. But it's going to take a long time to get there. In the shorter term, there's going to continue to be demand for stablecoins, both local and abroad. I think the backing by the banks is just the same backing of money that we have, the same fractional reserve problem that we have with everything else. And yes, each of the stablecoins that are using banks have to think about how to get enough diversity so they don't have concentration risk on any single part. Will there be failures? Yes. Will they be able to make those up? Probably so. Look, the entire space has some element of risk in it, but the risk that's in the space is not off par from the risk in the traditional financial system that's already there.
Yeah, it's hidden throughout, the fabric of different governments, et cetera. Like you just mentioned, several governments that, when you start debasing the currency, essentially that's a rug pull. It's the same kind of scenario that happens in the crypto community in some aspects. I want to talk to you about one more topic, and this is this whole theory around debanking crypto companies. This was Jake Tversky, who's one of the attorneys over at the Blockchain Association, and he mentioned on this, they're doing a FOIA request to the Fed, talking about unlawful debanking of crypto companies. Now, this is a concern because if this starts to cycle up, we've already started to see the pressure on Signature, Silvergate, et cetera, the crypto banks out there. Now you could maybe even look at someone like Sutton, who is right behind Robinhood in terms of support. What are your thoughts on how and if this is actually happening? And if it is happening, is this a problem?
Look, I think it's hard to deny that it's happening at some level. I think Senator Elizabeth Warren has been very clear on her position that she's not open to anything related to digital assets. And she's closed-minded on the topic. She's definitely got the ear of numerous appointees at the Fed, at the SEC, and other places. Look, the political winds will go one way and then the other, and we'll see a new administration, and we might see a different viewpoint on this. I'm actually happy that this debate is happening. Those that have been in the space 10 years, we talked about the ultimate, conflict between power and money, from the beginning of digital assets. And we've wondered how it will play out. These conversations need to happen. Some people are going to be really skeptical, and that's great. They should be really skeptical. Now, I hope that they are being above board and straightforward in what kind of rules they're applying to digital assets and other assets and applying the same rule base. And if they do that, that's really kind of all we can ask for. Are they surreptitiously trying to prevent Bitcoin and digital assets? I think probably yes. Just be above board about it. And we'll get through these debates. And in the end, digital assets are unstoppable. It is global. It is a new technology revolution, which actually makes money better. So it'll win. And if it doesn't win, what that means is that it's not better enough.
Interesting statement that you said there. Okay, so last point I want to hit on. I was looking at your Twitter account. It says reduce counterparty risk, segregating collateral from trading partners and exchanges held at BitGo. A couple of things here you hit on: bankruptcy, remote entity, $250 million in insurance policy. Is that enough? I feel like that might be. I feel low on that now after hearing all these bank collapse issues. And then qualified regulated custodio SOC1, Type 2 and Type 2 certified. Lot of great certifications here, I think. Do you feel like this is going to be something that, well, I'm sure that this is just going to continue to grow in terms of the things that you guys offer around tri-party solutions?
Yeah, look, there's a lot of demand for this. People are trying to eliminate single points of failure. And today, when we don't have any market structure where an exchange is acting as all participants, it's acting as the broker, the exchange, the clearinghouse, the custodian, the bank.
Right.
It's just too much concentration, and you need to break that up in order to have safety. On the insurance comment, I think it's a really important one to hit, especially right now. The banks, what just happened is that the federal government came in as the insurer of last resort, and
Right.
they are able to insure 100% because they can print the currency. So they can insure any amount. Now, when you come to assets where you don't have the ability to print more currency and you're looking for external parties, look, the global underwriting capacity for digital assets at tier one insurance providers today is only 4 to 5 billion. That means that BitGo and Coinbase and Gemini and all the other companies that get insurance are competing for like 4 to 5 billion of underwriting capacity. Obviously, that does not cover the full $1 trillion of assets that are deployed today in various types of digital assets. You will never be able to get 100% insurance for these assets when you don't have somebody's ability to just print the asset, which is what you have with the US dollar. So there's ways we take care of this and mitigate it, which is a longer topic, and we use segregated wallets and we can mitigate risk across any two wallets. Our customers are very happy with the approach we have. It's a huge insurance policy by any measure. So it's good. Full insurance is only there if you allow for the government to inflate you away as the insurance policy.
I think that's a good argument in the sense of the valuation of how you do back up something like an infrastructure around banks. But in reality, what's happening with the government is they're really backing the full trust in the monetary system, which is even a more important scenario than just this little Silicon Valley bank. Sure, it's a top 20 bank, but it's insignificant in the terms of trust. And I think that's where digital assets completely separate from the pack, because it is a level of trust. It is permissionless. It changes the dynamic. Mike, my last question to you, Mike, and this is just, I've been in business a long time, I've been in tech a long time, and I look at regulations and the scenarios of what's happening within the finance system. Do you think we're going to see this really make it through, especially with the regulatory concerns here in the United States? Or do we just see the stone wall eventually come up?
No, look, digital assets win on this for sure. You've been in the space a long time. You've seen it. The death of Bitcoin has been called thousands of times. I know there's a lot of skeptics out there, but the reality is that it really does work. You can send money from anywhere to anywhere in the world without a middleman. And that's a really important concept. I mentioned the human rights thing a few times already, but like imagine oppressed peoples if they had the ability to keep money like Bitcoin rather than confiscatable gold or bank accounts, which can just be taken from them. I mean, it's just so important. And then the other thing, audits aren't very good. It's funny, we still call it here in the US the big four auditing firms, and yet there's actually only 3 left because one of them is gone because it failed so badly. But audits are human processes to try to look at what are the assets and liabilities of companies. And with blockchain technology, we can put all the assets on chain so you can see it. Now we could also put liabilities on chain so you can see it. A regulator's job could be to make sure that all the assets are there and all the liabilities are there. But we ought to be able to get to real-time audits and financial solvency. And once you have that trust component, which you mentioned a moment ago, becomes way smoother. That's really the issue. We've got banks that are running in fractional reserve. They're required to, by the way, by the government, by the regulators. And now we have the opportunity to have 100% reserve banks. Now, some people might want to do speculative hedge funds and crazy investments. Great.
Right.
That's their money. They can do what they want to do. Other people want to just know, hey, I've got this money. I want to save it. I want it held in 100% reserve. Digital assets actually enable that in a way that the banking system has not.
Yeah, I mean, that brings me to, if you think about what Caitlin Long's doing with Custodia and what they were attempting to do is, to your point, 100% reserve banks out there, and yet the Fed denying them access into the system. I just wonder how much confidence we're going to really see around a movement of that nature. I think we're still going to be looking at fractional reserve for quite some time here. For sure.
Well, look, custodians and banks, a lot of people don't know quite what the difference is. A custodian is 100% safekeeper. So we are not a depository. We can't lend out your assets. We don't lend out your assets, unlike a bank, which is a depository, which can. So most people use banks because they like to get a yield. And it's much nicer to be paid than have to pay someone to hold on to your money. Obviously, it costs money. But we have custody. We know how to do this. Those are always 100% reserved. So whether it's the custodial bank, like what a BitGo is, I love what Caitlin's doing with Custodia. She absolutely should be given access to the Fed system. But yes, 100% reserve systems are coming, and people want them.
I agree. I think we're there. Mike Belshe, of course, CEO over at BitGo. Thank you so much for stopping in today. We appreciate it.
Thank you so much.
Excellent. All right, you guys are tuned in over on our podcast side of things. Make sure and jump over here to the YouTube channel. This is where you get these additional interviews that we do with leaders within the space. And it's really a great place for you to kind of jump into the community. It's also your fresh start into the Crypto Power Index if you know a little bit about how we track sentiment in the market. And best of all, you can join our own community, which is the Diamond Circle. The Diamond Circle drops a lot of alpha over on our Substack. It's very easy to join. Just click down below. Follow those links. You'll be able to just drop your email and you're in the circle for good. If you guys want to reach me, it's out there on Twitter at Paul Barrett. We'll catch you next time right here on TechPath.